If I asked you to make a list of your assets right now, how confident are you that you'd get it right? Let me guess, you'd probably write down your house, your car, your savings account, and maybe your retirement fund. Then you'd hand me the list thinking, that's easy. Those are my assets. But the truth is, you would be wrong. It's not that those things have no value, but what you've been taught is an incomplete definition of what an asset actually is. And that half-knowledge might be costing you far more than you realize. In this audiobook, I'll decode the whole game of assets that the elite investors and business people play to make millions while you're stuck paying bills. So, if you want to be financially smarter, subscribe to this channel. I upload practical personal finance audio lessons every week. Now, let's get back to the topic. The definition of an asset that most people carry around in their heads was handed to them by a culture, a school system, and a financial industry that had a vested interest in what they believed. The definition that an asset is simply something you own that has value is incomplete in a way that quietly keeps the middle class spinning in place for decades while the wealthy keep pulling away. The definition that actually matters, the one that changes lives when people finally hear it, is this. A real asset puts money into your pocket. A liability takes money out of your pocket. That is the whole distinction. Not what something is worth on paper, not how much you paid for it, not whether an accountant would list it on the asset column of their balance sheet. Does it generate cash flow that flows toward you, or does it require cash flow that flows away from you? That single question, applied honestly to everything you own, will rewrite your financial picture completely. Robert Kiyosaki introduced this framework in Rich Dad, Poor Dad, and it is one of the most clarifying ideas in popular personal finance. But this audiobook is going to go further than that. We are going to talk about fake assets, things that look like assets, feel like assets, are marketed as assets, but function as liabilities in disguise. We are going to talk about fake money that feels like wealth but evaporates under examination. We are going to talk about the specific liabilities that the consumer economy is engineered to sell you as investments. Then we are going to talk about the real asset classes that build actual wealth and create the kind of financial freedom that a paycheck can never provide on its own. Let me make this easy to understand with a practical example. Picture two neighbors. Both earn similar incomes. Both own homes of similar value. Both have cars in the driveway. From the outside, their financial lives look nearly identical. But one of them is building wealth every month, and the other is slowly drowning in obligations they have mistaken for achievements. The difference is not income nor intelligence. It is whether the things they own are working for them or against them. One neighbor owns things that generate returns, things that pay dividends, collect rent, produce royalties, or appreciate over time. The other neighbor owns things that require constant feeding, mortgage payments, insurance, maintenance, registration fees, and repairs. This is a relentless outflow that masquerades as ownership but functions more like a very expensive lease. This is what financial educators mean when they say most middle-class Americans are asset poor despite looking asset rich. The balance sheet looks impressive. The cash flow tells the real story. And cash flow is everything. Cash flow is the difference between a financial life that gives you options and one that gives you obligations. Think carefully about the things in your life that you call yours. Your house requires a mortgage payment, property taxes, insurance, and maintenance. Every month, money leaves your account to keep it. Your car requires a payment if you financed it, plus insurance, fuel, registration, and eventual repairs. Your boat, your vacation home, your recreational vehicle, all of them are consuming cash, month after month, year after year, in exchange for use and the comfort of calling them yours. None of them is sending money to you. You are sending money to them. That is the fundamental inversion that traps the middle class. They work to afford things. Those things then demand more work to maintain. The things multiply, the work intensifies, the freedom recedes. And at no point does anyone stop and ask the most important question in personal finance. Is this thing I am about to buy going to put money in my pocket, or is it going to take money out? Because if the honest answer is the latter, what you are buying is not an asset. It is a liability to wear an asset's clothing. And in America, liabilities are sold to you from every direction, at every stage of life, with extraordinary sophistication and zero disclosure of their true financial function. Let's name them: the fake assets that the American financial and consumer culture has convinced ordinary people are wealth-building instruments, when in reality, they are wealth-consuming ones. The primary residence is the most emotionally charged example, so let's be precise and honest about it. A home you live in can appreciate. Over long periods in the right markets, it often does. But while you live in it, it does not generate income. It consumes income, mortgage interest, taxes, insurance, and maintenance. When you factor in the total cost of ownership over a 30-year mortgage, many homeowners discover that their home appreciated at a rate that barely outpaced inflation, and when the full costs are included, the real return on their investment was modest at best. This does not mean home ownership is always a mistake. It means that calling your primary residence a wealth-building asset, the way American culture reflexively does, is a simplification that leads to dangerous financial decisions. Specifically, it leads people to pour money into their homes, renovations, additions, upgrades, believing they are investing when they are largely spending. Whole life insurance is one of the most aggressively sold fake assets in America. Insurance agents, who earn commissions that can exceed 100% of the first year's premium on whole life policies, pitch them as investment vehicles. What they do not tell you as prominently is that the returns on the cash value component of a whole life policy are typically far lower than what you would earn in a basic diversified index fund. The fees embedded in the policy erode returns significantly. The death benefit is not in addition to the cash value. In most structures, the insurer keeps the cash value when you die and pays only the face amount. For most people who need life insurance, which is a real and important need, a simple term life policy covering the years of financial dependency costs a fraction of the price and provides the actual protection that matters. The investment component of whole life is, for most people, simply a more expensive and less effective way to invest. Collectibles and luxury goods are another category that American culture quietly frames as asset-like. The wine collection, the art, the sneakers, the watches, the rare trading cards. Some of these do appreciate spectacularly in specific cases that become famous precisely because they are exceptions. The vast majority do not. And even the ones that appreciate carry costs, storage, insurance, authentication, illiquidity, that reduce their actual returns substantially. When someone tells you their watch collection is an investment, they are technically not lying. They are describing a possibility. What they are not describing is the probability or the carrying cost or the liquidity risk of an asset that has no buyer until you find one. Cryptocurrency deserves honest treatment here because it occupies a particularly confusing space in the asset conversation. Some cryptocurrencies have produced extraordinary returns. Some have gone to zero. The asset class as a whole is characterized by extreme volatility, minimal intrinsic cash flow generation. Bitcoin, unlike a dividend-paying stock, does not send you money for holding it, and a market that is heavily driven by sentiment, speculation, and narrative rather than underlying productive value. That does not make it categorically fraudulent. It makes it speculative. And speculation is not investing. Speculation is gambling with better marketing. There is a place in a diversified financial life for a small allocation to high-risk, high-reward speculative assets, but only after the real asset base is established, not instead of it. And then there is the subtlest fake asset of all, the one that almost nobody recognizes as such. The depreciating purchase was rationalized as an investment. The home gym you bought was because you were investing in your health. The professional wardrobe is justified as an investment in your career. The the luxury car you rationalized as projecting success to clients. These are not investments. They are consumption decisions that we dress in investment language, because investment language makes us feel better about the expense. Being honest about the difference between things we buy because they enrich our lives and things we buy because we have confused spending with building is one of the most powerful acts of financial clarity available to us. Now let's talk about something that very few personal finance conversations address directly: the nature of money itself, and how what we call money in the modern American economy is not quite what most people think it is. The US dollar is what economists call a fiat currency. It is not backed by gold. It is not backed by any physical commodity. It is backed by the full faith and credit of the United States government, which is to say, it is backed by collective belief. The dollar has value because everyone agrees it has value. After all, the US government accepts it for tax payments, and because the United States military and economic dominance have historically made that agreement feel very reliable. But fiat currency has an intrinsic and unavoidable property that makes it a poor store of wealth over long periods of time. It inflates. Since the Federal Reserve was established in 1913, the US dollar has lost over 97% of its purchasing power. A dollar in 1913 would need to be roughly $32 today to buy the same goods. This is not a malfunction. It is a feature of a monetary system designed to encourage spending and discourage hoarding. But it also means that cash savings left sitting in a non-interest-bearing account are losing value every single day. The dollar in your checking account is shrinking in real terms while you sleep. This is the fake money trap. Working Americans are paid in dollars, taxed in dollars, and conditioned to save dollars in savings accounts that for many years paid effectively zero interest, meaning the savings were actively losing purchasing power in real terms year after year. Meanwhile, the assets that protect against inflation, real estate, equities, commodities, productive businesses, are predominantly owned by people who already have capital. Inflation is, in its structural effect, a transfer of wealth from savers to asset owners, from the working class to the owning class. This is not a conspiracy. It is the mechanical consequence of how fiat monetary systems operate under conditions where asset ownership is highly concentrated. There is a second dimension to fake money that is even more immediate and personal. It is the money that feels real but functions as an illusion in your daily financial life. The home equity that exists on paper cannot be accessed without selling your home or taking on more debt. The retirement account balance that looks impressive but is decades away and subject to market risk you cannot control. The theoretical value of a business you built that has no buyer. The appreciation in your stock portfolio that disappears in a correction before you sell. These are all forms of paper wealth, wealth that exists in the accounting sense but does not yet exist in the cash flow sense. And paper wealth is not the same as freedom. Freedom comes from cash flow, from money that arrives in your account regularly, without requiring you to liquidate anything or borrow against it. The distinction between net worth on paper and cash flow in practice is the distinction between feeling rich and being financially free. Understanding fake money does not mean distrusting all paper assets. It means being precise about what you have and what it actually does for you today, not in the abstract future when conditions are perfect. The question is always the same. Does this put real, spendable money in my pocket regularly without requiring me to sell something or borrow? If yes, it is a real asset generating real money. If no, if its value is theoretical, future, or conditional, you need to know exactly how long you are willing to wait and what risks stand between now and the moment it becomes real. A liability is not just a debt. That is the narrow definition. The full definition, the one that matters financially, is anything that consistently moves money out of your pocket. Under that definition, the landscape of the average American's financial life is strikingly liability-heavy. And the disturbing part is how many of those liabilities were entered into voluntarily, enthusiastically, and with the sincere belief that they represented good decisions. The car lease is one of the most elegant liability structures ever sold to the American consumer. You pay every month, you own nothing at the end. The vehicle depreciates, you absorb that depreciation through your payments. You face mileage limits, wear restrictions, and termination fees if your circumstances change. And at the end of the term, you are offered the opportunity to start the cycle again with a new vehicle, carrying the same monthly outflow forward indefinitely. Lease payments are not an investment. They are a subscription to transportation with none of the eventual equity that even a financed purchase provides. And yet leasing is marketed as the smart, sophisticated choice, the way to always drive something new, always be covered by warranty, never deal with repairs. It is brilliant marketing for a product that transfers maximum value to the manufacturer and minimum value to the consumer. Revolving consumer debt, the kind that never quite gets paid off because spending keeps pace with or exceeds repayment, is the liability that most visibly bleeds people. We have touched on credit card interest rates in previous audiobooks, so I will say only this here. Every dollar of revolving high-interest debt you carry is a monthly invoice from your past self to your future self. It is your previous spending decisions continuously billing you with interest for choices you may not even fully remember making. There is no faster way to stop this bleed than to treat its elimination as the financial emergency it actually is. But there are subtler liabilities that rarely get named as such. The private school tuition that strains the household budget every month, a genuine desire to invest in a child's education transformed into a multi-thousand-dollar monthly obligation that forecloses other financial options for years. The boat is stored at a marina that costs dock fees, insurance, maintenance, and winterization for an asset used a dozen weekends a year. The vacation property generates some rental income, but rarely enough to offset carrying costs when honest accounting is applied. The gym membership, the club membership, the professional association membership, individually trivial, collectively a river of recurring outflows that were each justified at the moment of signing and rarely examined as a portfolio. The practice of auditing your liabilities, not just your debts, but every recurring obligation that moves money away from you, is one of the most revealing financial exercises you can do. List everything: monthly subscriptions, annual fees auto-renewed, insurance policies whose coverage you have never reviewed, service contracts, maintenance agreements, loan payments, lease payments, HOA fees. Everything that has a claim on your future income before you make a single choice about how to spend it. The total, for most households, is startling. And within that total, there are almost always items that deliver far less value than their cost. Liabilities that were accepted at one moment in time and never reconsidered. Every liability you eliminate is not just a saving, it is a double gain. You stop the outflow, and you free that cash to be redirected toward real assets, toward things that pay you rather than bill you. This is the fundamental reallocation that shifts a financial life from consumption to accumulation. Not a dramatic event, not a windfall, just the steady, deliberate work of replacing liabilities with assets, one decision at a time. So if fake assets are traps and liabilities are bleeds, what are the real assets? What are the things worth owning, worth prioritizing, worth sacrificing for, worth reorganizing your financial life to acquire? 5 categories genuinely deserve the name, and every one of them shares the same defining characteristic. They put money in your pocket, consistently, over time, with or without your active daily involvement. The first is income-producing real estate, not your primary residence, not a vacation home you hope to rent occasionally. A property, a single-family rental, a duplex, a small apartment building, a commercial unit, that generates rental income exceeding its carrying costs. The spread between what tenants pay you and what the property costs you each month is real cash flow. It is money that arrives regardless of whether you went to work that day. Real estate done right also provides appreciation over time, tax benefits through depreciation deductions, and a hedge against inflation because rents tend to rise with it. Done wrong, overpaid, undercapitalized, poorly managed in a declining market, it is a liability masquerading as an asset, which is why education and analysis before purchase is non-negotiable. But done right, rental real estate is one of the most reliable wealth-building vehicles available to ordinary Americans with ordinary incomes, particularly when entered through strategies that minimize the initial capital required. The second is ownership stakes in productive businesses. Equity. When you own shares of a company that earns profits and either distributes them as dividends or reinvests them to grow the value of the business, you own a piece of a cash-generating engine. You do not need to run the business. You do not need to show up. The business works, and a portion of what it produces belongs to you. This is the essential logic of stock market investing. You are buying ownership of earnings streams, not just speculating on price movements. Dividend-paying stocks in particular make this concrete and tangible. A portfolio of quality dividend stocks sends you money regularly, quarterly, sometimes monthly, simply because you hold it. That is a real asset producing real income. The third is intellectual property and royalty-generating assets. A book that continues to sell years after it was written, a song in a licensing catalog, a patent on a process or invention, a course recorded once and sold repeatedly, a brand or trademark generating licensing revenue. These assets share a remarkable property. They can generate income indefinitely, at near zero marginal cost, from work done once in the past. This is not accessible to everyone in the same way, and the upfront investment of time and expertise is real, but it is far more accessible than most people assume. In the digital economy, a person with genuine expertise in any field can create intellectual property, educational content, software tools, templates, guides that generates passive income. The barrier is not capital. It is a commitment to creation. The fourth is paper assets with income generation beyond simple index funds, things like real estate investment trusts, known as REITs, which are publicly traded companies that own income-producing real estate and are required by law to distribute at least 90% of their taxable income to shareholders as dividends. REITs give ordinary investors access to the income-generating power of commercial real estate, office buildings, warehouses, apartment complexes, data centers, without the capital required to buy a building or the management burden of being a landlord. They are liquid, diversifiable, and have historically delivered strong total returns over long periods. They belong in a serious income-focused investment portfolio. The fifth, and the most undervalued of all, is yourself. Your skills, your knowledge, your professional reputation, your earning capacity. Human capital is an asset in the most literal sense. Investment in skills that increase your income, a certification, a technical proficiency, a leadership capability, a language, a sales skill, generates returns in the form of higher earnings, better opportunities, and greater optionality in your career. The return on investment of the right skill development can exceed the return on any financial asset. A software engineer who learns machine learning and increases their salary by $30,000 has just generated a $30,000 annual return on what may have been a few hundred hours of learning. No stock market investment comes with that kind of leverage. Everything we have talked about in this audiobook points toward a single fundamental shift in how you think about money. Not a tactical change, a philosophical one. The shift from a consumer mindset to an owner mindset. From asking what I can afford to buy to asking what I can own that will pay me. From thinking about what your money can get you today to thinking about what your money can build that will pay you tomorrow. It is the idea that the wealthy have operated on for generations. The Rockefellers did not build their fortune by earning high salaries. They built it by owning oil infrastructure that generated cash flow. The Walton family wealth is not in their paychecks, it is in their Walmart equity that pays dividends and appreciates. The real estate dynasties of American cities were not built by people who worked hard and saved. They were built by people who acquired income-producing properties and held them through cycles. These are extreme examples, but the principle scales perfectly to ordinary incomes and ordinary starting points. The cash flow mindset asks one question before every significant financial decision. Does this move me toward more cash flow or away from it? Buying a rental property that generates $500 a month after costs, toward cash flow. Buying a vacation home that costs $3,000 a month in carrying costs and rents for $1,200, away from cash flow, unless the appreciation thesis is exceptional and your liquidity allows the wait. Investing in a dividend-paying stock portfolio, toward cash flow. Buying a luxury car on a 7-year loan, away from cash flow for 7 years, in exchange for nothing that returns. Taking an online course that adds a marketable skill to your professional profile, toward future cash flow. Upgrading your phone 2 years early, away from cash flow for a marginal improvement in a depreciating consumer device. Applying this filter does not mean saying no to everything that does not generate income. A home you love, in a place where your family thrives, is worth its cost even if it functions as a liability by strict accounting. Experiences, travel, relationships, health generate returns that no spreadsheet captures. The cash flow mindset is not austerity, it is sequencing. It is the discipline to build the income-generating asset base first, to let that base grow until it is substantial enough to fund the life you want, and only then to layer in the consumption that the culture tells you to buy now, on credit, before you have earned the right to afford it. The most powerful demonstration of this mindset in action is the concept of the asset snowball, different from the debt snowball, but equally powerful. Every real asset you acquire generates cash flow. That cash flow, reinvested into more assets rather than consumed, generates more cash flow. Each new asset accelerates the acquisition of the next. The portfolio grows not linearly, but exponentially, because the assets themselves are doing work. A rental property cash flowing $500 a month becomes a down payment contribution for the next property in 2 years. A dividend portfolio reinvesting its quarterly payments compounds into a larger portfolio that pays larger dividends. A royalty asset generating $200 a month funds the creation of the next piece of intellectual property. The snowball builds. And at some point, a point that feels abstract at the beginning but becomes very concrete as the portfolio grows. The cash flow from your assets exceeds your living expenses. That is financial freedom. Not a number in a retirement account, not a net worth on paper. Cash flow that covers your life. That is the destination. And every real asset you acquire is a step toward it. Let's get practical. If you are starting from zero, no investment properties, minimal investments, a balance sheet dominated by liabilities, what is the actual sequence? What do you do first, second, third? Because the asset philosophy is clarifying and motivating, but without a concrete path, it remains an idea rather than a plan. The first step is achieving financial stability, eliminating the high-interest debt that makes asset acquisition nearly impossible, and redirecting cash flow toward investment rather than interest payments. This is foundational. You cannot build a real asset portfolio while hemorrhaging money to consumer debt. Eliminating that debt is the precondition for everything else, and it deserves the same urgency you would give a financial emergency, because that is precisely what it is. The second step is building a liquidity base. Accessible savings that give you the capacity to act on opportunities, absorb unexpected costs without disrupting your investment plan, and take on the kind of calculated financial risks that real asset acquisition sometimes requires. Without liquidity, every unexpected expense is a crisis that derails progress. With it, the unexpected is manageable and opportunities become accessible. The third step, And this is where the real asset accumulation begins, is to start with the asset class most accessible to you, given your current capital, skills, and time. For most people who are just starting, that asset class means the stock market through tax-advantaged accounts. The specific addition here is intentionality about dividend-generating holdings. A total market index fund already includes dividend-paying companies. But some investors choose to complement it with dividend-focused funds or ETFs, like the Vanguard Dividend Appreciation ETF or the Schwab US Dividend Equity ETF, to build a portfolio with more explicit income generation, alongside growth. The dividends, reinvested automatically in early years, accelerate compounding dramatically. For those with the capacity and temperament for it, real estate entry can happen earlier than most people assume, particularly through house hacking, which we touched on briefly in an earlier audiobook. The principle is straightforward. Buy a small multi-unit property, occupy one unit, rent the others. The rental income offsets your housing cost, sometimes entirely. You build equity, you gain landlord experience on a manageable scale, and you do it with owner-occupant financing, typically a lower down payment and better interest rate than an investor loan would provide. Many people who are now operating multi-property portfolios started with a single house hack at a moment when they thought they could not afford to invest in real estate. For intellectual property and digital assets, the barrier is lower than almost any other asset class. The investment is time and expertise, not capital. If you know any domain, professional skills, a craft, a technical ability, life experience that others would pay to learn from, the tools to monetize that knowledge as a scalable, repeating income stream have never been more accessible. Online course platforms, self-publishing, licensing arrangements, consulting, and productized into retainer models. The initial creation requires significant effort. The ongoing income requires very little. The asset, once built, works while you sleep. The sequence is not the same for everyone. What matters is the direction. Every financial decision you make from this point forward should move you either toward cash-generating assets or away from cash-consuming liabilities. Life is not a spreadsheet, and perfection is neither achievable nor necessary. But the direction, the consistent, cumulative, deliberate direction toward ownership, toward income generation, toward the asset base that will one day make your labor optional rather than mandatory. That direction, maintained over the years, is the entire strategy, and it works. Here is what I want you to walk away from this audiobook carrying, as a simple and permanent shift in how you see the financial world. Most of what you have been told is not an asset. Most of what you have been sold as an investment is consumption. Most of what drains your paycheck month after month is not the cost of living, it is the cost of liabilities you agreed to, often without recognizing them as liabilities at all. The car that costs you $800 a month. The house requires $5,000 in maintenance a year. The insurance policy that invests your premium at 4% while the market returns 7%. The consumer debt charges you 22% to fund spending that is already forgotten. None of these is building your wealth. All of them are building someone else's. And on the other side of that ledger, real assets. Things that work, things that earn, things that send money toward you simply because you own them. Rental income, dividends, royalties, business equity, skills that command higher compensation. These are not exotic instruments available only to the wealthy. They are available to anyone who understands the distinction between an asset and a liability, who makes the decision to prioritize ownership over consumption, and who has the patience to let the asset base build across years rather than expecting transformation across weeks. The wealthy are not wealthy because they earn more, though often they do. They are wealthy because they own things. They have spent their financial lives accumulating ownership stakes in income-producing assets, and those assets now do the earning for them. That model is reproducible, not overnight, not without sacrifice, by anyone who understands the game and decides to play it. You now understand the game. You know the difference between what is real and what is fake, between what builds and what bleeds, between the asset that pays you and the liability that bills you. Start small. Start now. Own things that pay you, and let time do what only time can do.